Have you ever wondered why a really close U.S. ally, someone like Australia, could actually end up speeding up the whole global move away from the U.S. dollar?
It does seem strange on the surface, doesn't it, given, the long history there.
Right.
But once you look past the usual geopolitical stuff and really dig into the economic numbers,
Hmm.
well, the financial reasons pushing these allies away from the dollar, they're just getting, frankly, too big to ignore.
And that's the key thing we need to explore today, isn't it? Usually when we talk de-dollarization, it's all about, BRICS, Russia demanding rubles, China stacking gold.
Yeah, that story's familiar.
Yeah, we know that narrative. But what feels really new and kind of critical now is that key U.S. partners are jumping on this trend, and it's not ideology driving it. It's pure market leverage, high interest rates, and some very specific financial deals.
Absolutely. Our goal here is really to follow the evidence, to see how this market power, combined with access to, frankly, much cheaper debt, and just the instability in trade, how all that is pushing countries everywhere, not just the usual suspects, but major commodity exporters, key tech players in Asia, pushing them toward other currency systems, specifically the Chinese renminbi, the RMB.
Okay, let's maybe start with Australia then, because it feels like their situation really highlights how basic market forces can, well, maybe outweigh traditional alliances.
It's a perfect example. Australia is obviously a commodity giant, but China has gained this incredible leverage over them, particularly when it comes to iron ore.
Just how much leverage are we talking?
The numbers are staggering, really. China's importing over 100 million tons of iron ore every single month.
Wow.
You add that up, and China accounts for something like 75% of all global iron ore imports. 75%. When you're the buyer for 3/4 of the entire global market, you don't really negotiate terms anymore. You pretty much set them.
Yeah. And that's exactly what they're doing, using that power to push for RMB settlement.
Aggressively. And we have concrete proof. Look at BHP, Australia's biggest company, right? They're now settling 30% of their iron ore sales to China using the Chinese RMB.
30%? That sounds like a massive deal.
It is. It's a landmark agreement. We're talking about roughly $10 billion worth of trade, almost 90 million tons of iron ore. And the implications, they're huge. Think about it. Instead of 10 billion US dollars flowing into Australia.
They're getting RMB instead. Local Chinese currency.
Exactly.
But hold on, isn't that risky? Why would a huge international miner like BHP want piles of RMB, given the capital controls and it being less liquid than dollars?
That's the clever part of the strategy, you see. The money isn't really meant to be stockpiled in reserves forever. It's designed to be spent.
Spent how?
That's why we call it a sort of double whammy for the U.S. First, yes, Australia has less reason to hold on to U.S. dollar reserves. But maybe more importantly, that RMB they receive, it's very likely getting recycled straight back into the Chinese economy.
How so? Buying Chinese equipment, funding their operations in China.
Precisely. Buying Chinese industrial goods, funding Australian operations within China. It creates this kind of closed loop.
So China uses its buying power, forces the currency switch, and then makes sure the money flows right back to support its own industries. The dollar gets completely cut out.
That's the mechanism. And it creates enormous pressure. Because think about it. As U.S. import demand maybe slows down a bit, these commodity exporters become even more reliant on that huge, steady demand from China to keep their operations running.
So Australia feels forced to go along.
They have to concede ground. Look at Brazil. They're already doing, 30% of their trade with China in RMB. Australia seems to be just following that path. That's the path of least resistance, financially speaking.
And it's not just about how they settle trades, right? It goes deeper into how companies actually finance themselves. We're seeing a shift away from dollar loans.
Oh, absolutely. For decades, the default was dollar loans.
Yeah.
If you were a big global corporation, you borrowed in dollars. That's changing. And it's changing because of, let's call them systemic issues coming out of the U.S. economy.
But what specifically?
You can boil it down to maybe 3 core problems. One, the dollar's seen as, less stable maybe. Political friction, high debt. That worries people. 2, borrowing in dollars is just plain expensive right now. Quantitative tightening, fighting inflation, it pushes rates up.
Okay, stability and cost. What's the third?
The third is the U.S. economy doesn't really have that strong industrial base anymore for some crucial growth sectors. Think green energy tax, for example.
Right. Which brings us to that Fortescue Metals deal. That seemed pretty remarkable. One of the world's biggest iron ore miners, not going to the dollar market, but securing a huge, $2 billion loan in RMB?
From Chinese banks, yeah.
Yeah.
$2 billion RMB loan.
And the terms were pretty eye-opening.
They were incredibly strategic. First off, it's unsecured debt, underwritten by giants like ICBC and Bank of China. They're willing to take that risk because, well, they have a pretty good idea of where the money's going.
Okay.
But the really critical part, the interest rate.
It was incredibly low, wasn't it? Like 3.8% fixed.
Exactly. 3.8% per annum fixed. Now compare that. If Fortescue had gone to the open dollar market back then, the U.S. 5-year Treasury was around 4%. So a big corporate loan, which always costs more than the risk-free Treasury rate, you'd be looking at minimum 5% to 6% interest, maybe even higher.
So it's just simple math then. Why pay 6% in dollars when you can get the cash for 3.8% in RMB? It's not about politics. It's just cheaper money.
It's cheaper money, but it's also strategically brilliant. It's a mechanism often called vendor financing.
Vendor financing. How does that work here?
Well, this loan, it's specifically earmarked for Fortescue's big green energy projects. And guess what? They've already handed out a $400 million contract for zero-emission mining gear to a Chinese supplier, XCMG.
Okay, so China lends Fortescue the RMB.
Knowing full well.
That Fortescue turns right around and spends a chunk of that RMB on Chinese-made machinery. The money boosts China's own industry. It barely leaves their sphere.
You got it. That low 3.8% rate isn't just a nice gesture. It's effectively a subsidy for Chinese manufacturers, and it helps normalize the RMB globally. Beijing is using cheap capital to cement its industrial dominance, making dollar options look less attractive by comparison.
Okay, so we've got the commodity leverage pulling allies towards RMB and these really tempting financial deals like cheap loans. But what about the more geopolitical side? The balancing act, especially in Asia. Let's talk about South Korea, major U.S. tech and security partner, right?
South Korea is walking a very, very fine line, a precarious position, really. They depend on the U.S. for security, no question. But economically, they're massively dependent on China for trade.
And the U.S. isn't making it easy for them.
Well, U.S. trade policy, particularly around things like tariffs, market access, it's become incredibly unpredictable. People say it changes faster than the weather sometimes. That kind of volatility makes long-term planning almost impossible for countries like Korea.
You can almost see that tension in their diplomacy, can't you? Those symbolic gifts. I remember reading the Korean president gave China this high-end Go board.
Made from precious wood, yes.
Yeah.
That wasn't just a polite gift. That's a deep cultural nod. It acknowledges this shared heritage, sure, but it also implicitly says, we see you're playing the long game, the grand strategic game, you know? Like,
Yeah.
Go itself, it's sole acknowledging China's strategic patience and power.
It's basically pandering
Yeah.
because they have to.
It's definitely trying to smooth things over with Beijing because their economic survival kind of depends on it. They need stronger ties with China because that economic reliance is just so profound.
What are the actual economic impacts they're feeling?
Well, partly because of all the trade friction and tariffs. Korea is actually importing more Chinese goods, which makes their trade deficit worse. But at the same time, their own key exports to China, things like cars, other finished goods, those sales have just plummeted in the Chinese market.
That's a tough spot. And looking ahead, this must get even trickier with semiconductors, right? Where Korea leads with Samsung, SK Hynix.
Absolutely critical. That's the strategic imperative. Korea knows it has to mend fences with Beijing now because China is catching up fast across the whole semiconductor supply chain.
So Korea's current dominance is maybe temporary.
It's definitely temporary. They understand they need to lock in better terms, secure their position today before China potentially becomes a full peer competitor and doesn't need them as much tomorrow.
Okay, let's shift gears one more time to outright defiance. BRICS nations, and specifically the whole situation with Russian oil sanctions. The U.S. sanctioned major Russian oil firms. But the oil is still flowing, isn't it?
It absolutely is. The reality is the U.S. has basically zero leverage to force China, for example, to stop buying Russian crude. And critically, we've had India come out and confirm quite clearly that the supply to their refineries will keep flowing, no interruptions expected.
People often frame India's choice as just being about the discount. Oh, they get cheap oil. But is it more complex than that? What's the full incentive for them to resist Washington's pressure?
The discount is definitely the foundation. Russian crude consistently trades, $8, $10, sometimes $12 cheaper per barrel than the global Brent benchmark. And since 2023, Russia's become India's biggest single supplier, over 30% of their total crude imports.
So that cheap oil is basically subsidizing their economy.
Massively. It subsidizes Indian industries, helps keep inflation lower than it would be otherwise if India suddenly had to switch back to, say, more expensive Middle Eastern crude.
Inflation spikes, their exports become less competitive.
And they become much more reliant on U.S. energy policy and, frankly, U.S. goodwill. Plus, shifting massive supply chains like that. It's incredibly complicated and expensive. And there's a diplomatic angle, too. By resisting the sanctions, India asserts its non-aligned stance and maximizes its own economic interest.
Which leads us to that classic sanctions game, the whack-a-mole problem.
Entirely predictable. We're already seeing reports confirming it. Indian refiners just recently bought, I think it was 5 cargoes of Russian oil, but from entities not currently on the sanctions list.
So Russia just sets up new companies?
Effortlessly. New shell companies, find independent traders, use the shadow tanker fleet. As long as that $8 to $12 discount, that arbitrage opportunity exists, someone, somewhere will find a way to move the oil. The sanctions might reroute it, make it a bit trickier, but they don't really stop the flow.
This does raise an interesting point about the U.S. motive, though. Officially, the sanctions are about punishing Russia for the conflict. But is there maybe also an economic angle, a desire to remove a competitor for U.S. oil exports?
Well, the timing is interesting, let's put it that way. U.S. oil production has been hitting record highs. Recently touched 13.8 million barrels a day. That's an enormous amount of oil.
And they need buyers for it.
They absolutely need global buyers. If cheap Russian crude is soaking up demand in major markets like India and China, U.S. producers could face a serious glut domestically. That pushes prices down, hurts their profits.
So pushing Russian oil out doesn't just serve a geopolitical goal, it also conveniently clears the field for U.S. energy exports, helping support prices and demand for American oil.
It certainly helps the U.S. energy sector find markets, especially at a time when, as we've seen, even allies are actively looking for cheaper energy and financing alternatives elsewhere.
Okay, so let's try and pull all these threads together. What we're seeing is pretty clear evidence that this global shift away from the dollar isn't just about ideology anymore. It's being driven hard, maybe even accelerated by just unavoidable market realities.
The evidence is very specific, very measurable. You've got the sheer weight of commodity markets, like China's grip on iron ore, and you have these undeniable financial wins like Fortescue, grabbing that 3.8% RMB loan instead of paying 5 or 6% for dollars. That kind of financial pragmatism seems to be overriding historical ties much faster than maybe people expected.
It really feels like this is defining the next phase of global finance. It's coming down to the cost of money, the reliability of your suppliers, and just the sheer scale of market demand. Those are the things driving decisions now.
Which leaves us with a really important final question for you to think about. If close U.S. allies are increasingly making choices based on these immediate pragmatic financial benefits, cheaper loans, reliable trade in non-dollar currencies, does that economic logic start to fundamentally outweigh historical alliances? And if finance is dictating alliances now, what does that really mean for the dollar's future role, its stability, its centrality in this emerging multipolar world?